The world's financial regulators are currently trying to decide what measures to take to both satisfy public opinion and to ensure that the financial collapse that we almost saw doesn't happen again. So how much regulation is needed? Where, what, and why? These are the key questions. And here to talk about it with us is INSEAD banking and finance professor Jean Dermine. He's also the author of the book, Bank Valuation and Value-Based Management. Thank you for being with us.
Thank you, Julie.
We'll jump right into this. What needs to be overhauled by regulators today?
The problem that is raised for me is that banking was already heavily regulated before the crisis. That did not prevent the crisis from happening. And therefore, it seems that having more regulation is unlikely to do the job.
Is this part of the overall discussion, too, that on financial regulation that's being discussed in Washington that includes taxing banks, putting a tax on banks?
It's basically to say no more taxpayers' money should be used to bail out the banking system. And that's the idea of putting large banks into default to put the losses on creditors. So as long as large banks are systematically bailed out, and that was again confirmed to the crisis, creditors have nothing to lose, therefore they are not putting pressure on banks. So if risk is priced properly, then I'm sure banks will do a much better job in controlling risk.
Well, we're talking about risk, derivatives, hedge funds, that sort of thing, which are sometimes too complicated to explain.
I mean, we should remember that some of the very first derivatives were created in the 17th century. It was on the price of tulip bulbs in Holland. The point is that derivatives have been around for 400 years. And in my opinion, the problem with the crisis has absolutely nothing to do with derivatives. And just to give a proof, if you look at the banking crisis in Ireland, this had nothing to do with derivatives. It was plain vanilla lending to the real estate sector. So how to manage risk properly? In fact, it is quite surprising when you read many of the new regulatory proposals on liquidity, on stress testing. They were all in the regulation in place already 5 years ago. So the big question is not that we need new regulation, is to ask the question, why were they not enforced by regulators in the first place?
Who would evaluate that? You see a special commission or just the structure in place?
You need a special committee, a special task, okay, to come with clear criteria how to evaluate a risk manager. Okay, the same with bank regulator. There could be tools like to look at the pricing of spread on bonds issued by banks, the pricing of credit derivative of banks. There are all kinds of indices to see whether the banking system is getting closer or not to problems.
Part of the problem today is that the public around the world wants revenge, and they hate the banks. And so governments are going to respond to that. This is my read of the situation. So how much of what you see going on now in terms of calls for regulation is pandering to public outcry, and how much is really needed on a fiscal financial basis?
So my naive belief is that head of states should not respond to a pure public outcry, which we fully understand. I fully agree all these regulatory proposals, which by the way are pushed extremely quickly, it's clearly to meet short-term political objectives. In my opinion, this is pretty bad because it could damage the banking system. It will make economies less efficient. That will be very bad for everybody. Therefore, we would like people to calm down, to understand what is the value of a banking system to economy, and then indeed to come with proper proposals.
Do you get the sense that the heads of state are moving in concert, or are we beginning to see some national fallout that they won't want to go along?
I don't believe that there will be much coordination for a very simple reason. There is a big fight going on between New York as a financial center, of course London, Frankfurt, Paris, Asia want to attract business to them. And therefore, I am extremely doubtful if they're going to be able to agree on coordination. Just give you an example, hired recently hedge fund managers, already moving away from London to Geneva for a very simple reason, because the regulatory tax climate seems to be better in Switzerland. Well, these are very, very clear signs of a total lack of coordination. So, as you have said, following the backlash, there will be a lot of regulation. And therefore, I can believe that for the early years to come, the financial system will be handicapped by this regulation.
Now, let me end by looking at Goldman Sachs.
Let me make 3 points related to Goldman Sachs. First, contrary to what has been said, we are not talking about arcane, very complex products. Okay, it is simply that they were selling products related to the US subprime market. These assets were yielding high return before the crisis, and there were investors, like, as an example, EKB, the German bank, willing to buy these risky assets. Number 2, it is raising a fundamental principle. Until now, the view was that the small investors had to be protected because they did not have the information to evaluate the risk, and that the big investors, the banks, the pension funds, the hedge funds, were big boys, big girls. They could take care of themselves. For Goldman, there may be a legal issue if indeed they've given false information to their client. That the case will tell us whether or not they've given false information. Okay, that remains to be demonstrated. And then the third point is now a basic issue of management and of reputational risk. Even if a financial institution is selling products to large clients, if you believe that the product is of high risk, okay, should you tell or not your client? Okay, and that people can refer to morality or not, but I would refer more to basic management of a firm. Okay, how much care do you take of your clients? Again, personally, I do not believe it should be regulated. It is for a company to decide, okay, whether or not they want to take their interest of their client first, and therefore inform them about the risk they take. And the market will decide which type of institutions should survive.
Thank you very much, Dermine, for being with us.